You heard the brief discussion on, gee, the economy might be stronger, so rates go up, but that's bad.
Yeah. So I think it's good. I actually see the world through a rare kind of a half-full lens these days. I know that you're always accusing me of being too bearish on markets.
Well, it's been good for 2 years.
But I think that markets are actually in a pretty interesting spot right now. And to borrow one of your phrases, I think that positioning right now is backwards when it comes to cyclicals versus defensive. So
you're going with the cable friendly.
I'm going with the cable friendly version. But I think that when you look at where investors are positioned, we have been talking about this recession for 6 quarters. Folks have been getting more and more defensively positioned. This recession keeps getting pushed out.
And defensive about calling for a recession because it hasn't happened, has it?
Well, exactly. So it hasn't happened, and it keeps getting kind of like pushed out into the future. Now, if you look at a lot of economists, they're dialing back their recession forecast altogether. Our team is forecasting a recession of, peak to trough 0.8% drop, which is kind of a non-event if you think about it. It's half the typical magnitude of a recession. Meanwhile, the world has bought bonds, sold equities, bought utilities, sold financials, bought everything that's safe, defensive, and does well if interest rates fall. And all the cyclical stuff that does well when interest rates rise is actually, I think, going to be the pain trade going forward.
We've seen, and we mentioned it yesterday, that we always hear there's going to be a change. Every time there's going to be a new uptrend, we hear a change of leadership. Why is tech once again seem to be, that's going to be leading again, isn't it?
I don't think so.
I think tech is... The reason the S&P is where it is because of 4 tech stocks.
I agree. So I think the S&P might not be the index you want to buy. I think you want to buy the S&P X big tech, or S&P equal weighted, or however you want to cut it.
Because of valuation?
Because of valuations, because of demand. I mean, we just heard about demand slowing down. I think what we're in right now is an environment where tech is showing its cyclicality. So when you think about what we all spent on over the last 2 years, it was tech, because we couldn't go out, we couldn't, do anything. So companies, consumers spent on tech. And now we're seeing that demand pull forward during COVID in 2021-22 turn into declining sales volume. And I think that's something that still hasn't been priced into technology stocks. I think there are bullish themes, but there are, pockets like AI, I think is a great bullish theme. But for the overall market, what makes me really excited is that companies are actually spending on efficiency gains. Right? They're spending on productivity. And this is something we haven't seen in a very, very long time. We've seen cost cutting. We've seen buyback driven per share growth. We've seen lots of financial engineering driving earnings growth, but we haven't really seen a strong productivity cycle. So I think we could be. So I'll tell you, in conversations with clients, nobody thinks that the multiple of the market is too low. They think it's too high. I think the multiple could move higher on the idea that we're at a point where cyclicals could actually really grow earnings and expand margins. But I think it's a case-by-case market. You don't want to buy mega cap tech. I think that's old leadership, and I think you want to move to
So what's the multiple on the average cyclical right now? Is it single digits? Or?
Well, the multiples are high right now, but I think that's because we're sort of troughing in earnings. Right. And in our view, we're going to see earnings trough by the end of this year or thereabouts. Timing is difficult, but if you look at next year, what I think we could be setting ourselves up for is a pretty healthy recovery. This is assuming the consumer holds in. And when you look at consumption trends, the only area of weakness is in higher income, right? That's the other difference today, is that luxury and high income spend is no longer defensive. You want to go discount, trade down. I think that's the other sort of really interesting cross current that's driving markets today. So the danger is, and I think this is a really interesting time to be an investor, and there's lots of alpha to be made, but the danger is using 2008's playbook, because that's wrong. We're not in a market environment where credit and banks and cyclicals are going to drive the economy lower. We're in a market environment where the big asset bubble is in long duration growth stocks. And that still hasn't, kind of fully right-sized.